Bets on rate cuts are rising and the bond market is moving in tandem. Treasuries rallying and at the fastest clip since 2008. The momentum helped by some dovish Fed speak in recent days and progress on inflation, despite the core number remaining somewhat sticky. Our next guest has been overweight equities all year long, and he says it wasn't a popular call at all, but they remain there. Joining us now, we've got Ryan Detrick, Carson Group's chief market strategist, here live in living color with us. Yes. Ryan, great to see you in person today.
This is a great studio. I'm glad to be here, guys.
Appreciate it. We put a lot of work into it here. Look, you put a lot of work into these calls over the course of this year. Some of them unpopular at the time that you made them. Why do you continue to stick by them? And at what point do you kind of reverse or change course?
Yeah, Brad, you think about it. A month ago right now, we were in a correction. It felt like the end of the world. Yet, if we look at really the consumer, I mean, I know you guys have talked about it, the consumer, we're still making 200,000 jobs every month. Productivity is strong. We're looking at all-time record high earnings next year. Things aren't perfect. Delinquencies are creeping up. We're aware of some of the cracks that are out there. But just overall, it still makes sense to us when you look at the overall picture of a market that simply is seeing more participation, right? We all know 7 stocks were going up. Kind of disagreed about that, but now we're seeing way more participation just in the last 4 weeks or so. So again, we get into some of the more things we see, but we've been overweight since December last year. People hated that when we did it. We're still there. We still think next year the bull market's here, and there's probably not going to be a recession either.
Ryan, when it comes to some of those opportunities that you are identifying right now, you just mentioned the outperformance, obviously, of the Magnificent Seven this year. Where do you see leadership coming from next year?
Yeah, you think about it again, a year ago right now, right? Tech stocks were getting crushed. Magnificent Seven, most of them were cut in half, if not more. What do you hate right now? People don't really like small caps as much. Now, maybe they do a little bit more because of the rally, but we like small and mid caps because we don't see a recession. We also see a Fed, like the great discussion you just had. The Fed is probably done. We've been in that camp. Will they start cutting? Maybe middle of next year. But again, you don't have a recession and the Fed starts to cut. We think that small and mid caps and cyclicals in general, those are the areas we've been tilted to in the models we run for our Carson partners. We still like those areas. I mean, think about what's cheap. I mean, there's not a lot that's cheap out there. Small and mid caps are cheap relative to large caps on a historical basis.
Right, and if you do though see a mild recession, I know you're not expecting him, as some other strategists out there are forecasting a mild recession. Does that at all change where you're seeing the opportunity?
I mean, sure, it would. I mean, again, we would probably want to shift a little more overweight to the more defensive areas. But what's the market telling us, right? We're seeing your defensive areas, your staples, utilities, a little bit of real estate, still lagging. And that's normal for a healthy bull market. So until we see that change, it's hard to get overly cautious, I guess I'll say.
Does the political environment that surrounds a lot of central banks at this point going into a major general election year, not just here in the U.S., but in certain other developed nations around the world as well, you think about that. How do you layer that into your investment thesis?
Yeah, I mean, believe me, central banks matter. Obviously, we just had a bunch of hikes. We saw what happened. And again, you know, let's talk about the election for a minute, right? I mean, pre-election years normally are pretty strong. Well, when you have a first-term president, S&P's up 20% on average. We talked about this, I think, like a year ago, to be honest. They were up 20%. When you go to the election year of a first-term president, the last 10 have been higher. So election years have been higher the last 10 times of the first-term president. There's lots of other factors. We're aware of that. But when the fundamentals are there, it is what it is. Washington can pull some certain levers to keep things moving. And we still think it's not a reason to be worried just because it's election year. I'll put it that way.
Ryan, we're talking a lot about 2024, but what about December? Because I know you do a lot just in terms of tracking the performance historically and maybe how we are set up to perform. So what do those gains potentially look like over the next 4 weeks?
Yeah, we think there's still some gains coming, is the short answer. I mean, you think about it, what's the old saying, right? Don't short a dull market. And Jared and I were just talking about this a minute ago. The last 5 days, the S&P 500 has not gained or lost more than 45 basis points. It's 0.45%. What in the world does that mean? Well, that is not a lot of volatility. That's a dull market. The last time we saw that was April, almost 7 months ago. 3 months after that, the S&P gained 10%. Now, that's just one sample size. I get it. But this market, we're going to look at one of the best November gains ever. And now here we are just kind of going sideways. To us, it's like the market's catching its breath, which turns into December. December is usually strong, up 1.4% on average. No month is more likely to be higher. But a pre-election year, those returns actually double. And, it is what it is. We still think there's some upside here for a year-end chase, as so many people have been doubting this market just a month ago. Look what everybody was saying. And there's still a lot of reason to think there can be a chase into the end of this year.
We always love the optimism from you, Ryan. I got to tell you, there's always opportunity in your eyes, Ryan. And great to have you here in studio. Thanks so much for stopping by.
I do want to say my favorite Charlie Munger quote,
Yes,
if I
please.
can, because that was a great discussion you guys had earlier. He said, you know, it's not supposed to be easy. If somebody finds it easy, they're probably stupid. I think that's a pretty good Charlie quote. We are going to miss him. He's a legend, and I like that quote. So thanks for having me, guys.
We all
So
certainly
many.
will. Ryan, thank you so much again for stopping by the studio.
Appreciate it.